and Head of Overseas Treasury over at HDFC Bank. Great to have you both with us. Anurag Singh, coming to you first. Like we've said, it's not so much about what the Fed does now by way of hiking rates, which is more or less factored in by the markets, but what it says that is going to be more crucial. And the Fed has signaled that by early 2023, they're expecting to have raised rates much higher than they had projected at the June review. How high do you expect them to go?
Vikram, good evening. So Vikram, I wish even the Fed knew how fast, 6 to 9 months, what they've done. Last September, they said they probably might need to go just about 0.5% in 2022. Then they came back in March and said they would probably need to go to 1.9% by end of 2022. They came back in June, said, oh, probably we will need to go to 3.4% by end of 2022. And here we are. Yesterday, they said now probably 4.4 would be the right number to go. Fed is completely missing the numbers and losing credibility here. Effectively, Fed is really just chasing inflation from behind. So that's the picture, Vikram. Look, nobody knows for certain what is going to unfold. and I think even Fed is not sure. But I think the track that I told you, just within last 9 months, tells you effectively that even the Fed doesn't have an idea. My fear is, and although with Powell's confidence yesterday that we will be able to have a price stability basis this track, this is the third version of the track which is ever changing.
Fair enough. Yes, there is no clear path to this, but Bhaskar Panda, besides, the kind of movement that we've seen in recent times in the markets with what the Fed has announced, do you expect more outflows as far as the markets are concerned, the Indian markets go? Looking at the way bond yields are spiking right now, what do you think is going to happen?
See, first of all, Fed hikes, as my colleagues just said now,
yes,
has not been predicted the way it has been, and not been predicted by Fed itself. Okay, so we don't know where they will stop, but for sure they will stop somewhere. I don't know. Nobody can predict right now. But the next question is how it is going to impact the Indian market. Indian market is already impacted by these things, but I have a feeling that the growth in Indian market and the growth differential between the Indian market and others will be favoring Indian market. Therefore, the depreciation that will come in rupee probably will be calibrated. The second thing that I think is going to help Indian rupee in the medium term is that if we are part of the global index, as is being talked about by many, so there would be inflows into Indian market. So these are the two positives. Third positive is that the oil prices have been actually trading lower, below $100 for quite some time, and probably they are going to remain, below $100 for, foreseeable future. So these three are positives for USD INR. Obviously, when dollar index is going up, when the dollar interest rate is going up, the investment, risk-free investment always goes back to dollar. So therefore, that's also a foregone conclusion. Now, the question comes how to, manage the USD INR in the short to medium term.
Yes,
I think we have seen central bank taking a lot of action in the last few months to keep it in range-bound trade, and probably similar kind of action could be anticipated going forward. And to add to it, if you see today, BOJ has intervened in the forex market after almost 2 decades, after 1998, if I remember correctly. So they have intervened in the forex market. So that is also to be kept in mind because they are a Asian central bank. Though we are in very different territories, and there are a lot of differences between Japanese economy and our economy, so on and so forth.
Anurag, typically, theoretically at least, isn't inflation in emerging markets higher than developed ones? And if so, interest rates are also higher in emerging markets. Doesn't it make sense for investors to borrow at lower interest rates, say in the US, where interest rates are lower, than those in India and buy into Indian bonds where they can earn higher interest rates? Do you expect that to happen?
Yeah, Vikram, some of the I would say that those people are not financially literate. Some of the people try this experiment,
Yes.
but I think all of this is lost when the exchange rate loses value, right? It's a futile exercise. It doesn't make sense. I mean, everybody knows interest rates here are usually used to be like pretty 1 or 2%, and Indian interest rates were higher. But then you never know when rupee will lose value and it will all nullify the impact. You can try timing it, but good luck with that. So that's not a right strategy. Look, our rupee loses value because there is inflation differential. So if you're trying to play on the arbitrage of interest, then you're basically trying to play against the basic economics or interest rate differential rule, right? So it doesn't work. Vikram, not recommended, and certainly not recommended. Retail doesn't have the sense to time this in any way.
I mean, there are so many unknowns right now, Bhaskar Panda. As far as the central banks are concerned, at least there is this coordinated move, at least, that we are seeing as far as hiking rates are concerned. The Fed, of course, not alone in hiking rates. Bank of England had multiple rate hikes since December. We've seen it in Australia, Brazil, Canada. All of them have raised rates. The European Central Bank has announced a 0.75 percentage point rate hike too. So what do you expect now the RBI to do at its next policy meet later this month?
The answer lies in your question. So
no, but how much? And, in terms of this resilience that we are talking about, the kind of numbers, the print that we have seen in recent times, do you think the RBI story could be drafted a little differently compared to the rest of the world?
No. See, let me tell you, what's the difference between, say, Fed or Bank of England and us. As I said very clearly, our growth rate and our future growth, which we are, projecting, will be much higher than these two economies. First thing. Second thing, Fed's policy is to keep interest rates within 2% range. Okay, but they are right now at 6%. So that's the reason why Fed has been, been after the inflation and will be after the inflation till they bring it down to their 2% target. Okay. In case of Indian scene, we are still much better off than others. Therefore, I don't foresee at least a huge hike this meeting. Maybe I'm expecting, this is my personal opinion, obviously, is that around, say, 40 basis point increase this meeting.
Yeah.
But they will talk about probably growth versus inflation.
Yes, exactly, and that's the balancing act. Anurag, do you agree with that view? Very quickly, we're running out of time. Sorry.
Yeah, Vikram. Look, I largely agree. 7% inflation is not too bad in India. We are used to a 6% inflation, right?
Sure.
But again, I think excessively hiking rates will just kill Indian businesses. It's not going to help grow the economy, which is basically should be our strength.
Thanks very much, both Bhaskar Panda and Anurag Singh. Always a pleasure talking to you, gentlemen. Thanks very much for joining us with your perspective on India tonight. We're talking about